Do you find yourself wandering through a forest? Thick, scary forest. It's nighttime. The foliage is thick. The sounds of flora and fauna surround you. What's that? A wolf? A bear? A tiger? You don't know. Behind every tree is a moving shadow. It represents some threat to your wealth you can't understand. You know you need to get out of this forest, but you also don't want to wander off a cliff or into a river full of piranhas. Moving forward is scary, but sitting still is even worse. Sometimes the real estate market can feel the same way. You've got your machete, you're wearing your boots, and you've got a canteen of water, but you don't know which direction to head in. Suddenly, a light appears. The light is comforting. It instills confidence in you. You move towards it. As you move even further, you get more clarity. Each step brings a better picture and confidence out of the situation that you're in and into a better future. That light is BiggerPockets. And we're here to shine it even brighter as we lead you into 2024 in getting your first rental property. Christian Batchelder, welcome to Mortgage Monday. How are you today?
Doing good. Got a fun episode going into 2024 for everybody.
Yes, sir. We're going to be talking about how to finance your first deal in 2024. So if you've already bought real estate, hang in there because you'll probably hear some things you didn't know. But if you've never bought real estate, this is definitely an episode for you because we're going to be pulling back the curtain and showing y'all what goes on in financing and how it's not nearly as scary as you may think to get pre-approved for a loan and even close on one. So we're going to talk about loan options for primary residences, loan options for non-primary residences, meaning where you don't live anymore, and then how house hacking can be a way of combining real estate investing with living in a house, which is a great place for a lot of people to start, as well as what conforming loan limits are.
But before we get into that, remember when you had to pay to get a lead's phone number? It was like the dark ages until DealMachine made skip tracing a thing of the past. Now, with your DealMachine plan, you get unlimited access to phone numbers and contact information for no extra cost. That's right. Get high quality, reliable information trusted by leading financial institutions, all fully compliant with the federal do not call list. Explore over 150 data points, including age, gender, marital status, occupation, and so much more. Trust me, this is the data you need for your off-market deals. With new filters, people flags, and color-coded phone numbers, lead management just got a whole lot easier. Ready to step up your investment game? Sign up for a DealMachine plan today and gain immediate access to this unlimited treasure trove of contact information and phone numbers. Just head over to DealMachine.com/BP. Transform your lead generation and deal-making strategies with DealMachine. Sign up today and start exploring the unlimited possibilities at DealMachine.com/BP, like BiggerPockets. Now, back to Mortgage Mondays.
So let's jump into this thing. Christian, I want to start off with conforming loan limits. Let's talk about that. What is a conforming loan limit? Why do they differ from area to area? And what do people need to know about them to get pre-approved for a loan?
Yeah, really good questions here. Kind of what everybody's used to hearing, Fannie, Freddie loans, right? You hear of government loans. They're within a realm of loan amounts. Some markets are lower, some markets are higher. But depending on where you are, that zip code, right, or the county you're in specifically, has a conforming loan limit associated with it. And these vary all over the country. And especially the last few years with the increase in purchase prices, with inflation, with everything that's going up, we kind of get excited at the end of the year because these high cost and baseline loan limits increase typically going into a new calendar year. And we just got the announcement that they are increasing going into 2024. But we're actually going all the way up to, I always like to look at the 4-unit one because we do a lot of house hacking and, multifamily investing. The new high cost area, which is the LA counties, the San Diego counties, your high value areas in the country, you can get a loan on a fourplex now for over $2.2 million. If you told me 5 years ago that would be where the high balance loan limit is, I would call you crazy because it's never been anywhere close to that. But with the increase and especially what multifamily properties have gone up to, we're super excited to share this, and it's going to open the borrowing box for a lot of people looking for multifamilies in these high balance areas for sure.
So when you're getting a conforming loan, they're also known as Fannie Mae or Freddie Mac loans. These are usually where you get the very best interest rate. Not all the time, but as a general standard, that's what you can expect. They have a limit for how high the loan balance can go. So they'll let you borrow up to a certain amount. And if you want to borrow more than that, you can't. You have to actually bring extra cash to the table. Now, certain areas, the loan limits are high, but if you want to buy a more expensive house, you wouldn't be able to use a conforming loan which means you have to use a non-conforming loan, and those are typically referred to as jumbo loans. There's a ton of different jumbo loans, but jumbo loan is a word, if you've ever heard it, that is used to describe when you need a non-conforming loan because the loan balance is too high. Now, more expensive areas have higher loan limits, so you're less likely to need a jumbo loan, but if you're trying to buy a mansion in just about any area, you probably aren't going to be able to use a conforming loan because not as many people buy mansions. Not only do you have conforming loan limits, but then you have what we call high cost area loan limits. So there is a ultra limit that you can go to, but your rate's going to be higher, your closing costs might be higher. So oftentimes you'll hear your friends say, I got an interest rate of X%. And then you get quoted and it's Y. And you wonder, why is it higher? Well, that's why. It might be a high balance loan or a high cost loan because the house that you wanted cost more than the house that they bought. There's a lot of little nuances. It's never like a 4% difference, at least not in the loan range that we're in right now, but it might be a 0.5% higher, 1/4% higher, something like that. So speaking about down payments, this is where a lot of people get caught up. There's still people out there, and you may be one of them, that think you need 20% to put down on a loan. Christian, is it true that you have to put down 20% on any property?
Absolutely not. By far and away, the most misguided idea that's out there with investing into real estate is that you need a 20% down payment. And with some of the property values in a lot of these areas now, that's almost unachievable for a lot of people, right? The house is going to appreciate faster than you can save 20% down, right? So breaking down the few options that are available, as we shared on a previous Mortgage Monday episode, check it out if you haven't. Fannie Mae announced a couple months back that we're now allowing 5% down on multifamily properties. That's 2 to 4 unit properties. That was never available before. So that's 5% down. The caveat is that you have to live in it. So this is a primary residence loan, 5% down requirements. If you are able to pursue an FHA loan, we got 3.5% down requirements. Also very low. Much more likely that you can save 3.5 or 5% of a down payment with property values being where they are versus waiting to save up 20 or 25% in a lot of these cases. So use these loan products. You can buy one primary residence a year, buy one, move out, buy another one, move out, buy another one. And in 3 years, you got a little portfolio building and you only had to put 3 to 5% down for each one.
That's right. There are some loans that are 3% down, others like FHA that you may have heard of that are 3.5% down, and then other conventional loans that are 5% down. Now, of course, you can put down more if you want. We're talking about the minimum. Now, some people will confuse the word FHA with primary residence. That happens a lot, but they're not the same. An FHA loan is a type of primary residence loan. There's also conventional loans that are primary residence loans, and then there's VA loans for people that were in the military or USDA loans for people that live in rural areas. Christian, what are some of the loan options if somebody was in the military and qualifies for a VA loan, or maybe if they're married to someone in the military, or if they're in a rural area?
Yeah, if you are a veteran in the military, you have access to, by far and away, and it's not really even close, the best real estate financing strategy in America, and honestly in the world. The VA loan is the best loan in the world. It is 0% down. It is lower rates than anything else, and there's no PMI. It literally does not have a negative factor to it. I guess if you want to call it negative, it has to be for a primary residence. But if you're a veteran and you're not buying one primary house a year for 0% down with no PMI and no down payment, you are not utilizing the best investment tool that is out there.
Now, you mentioned PMI. When you mentioned that, can you describe what PMI is?
The most simple way that I had it explained to me when I first entered the industry is that it's a tax for putting a low amount down. That's basically how you can think about it. It's in actual terms, it's an insurance policy that you're buying because your risk of foreclosing is very high when you only put 3 or 5% down. You basically pay a premium to your lender to protect the lender's investment. So if the lender knows that they're leveraging 95% of an asset and you're only coming with 5% down, the lender's saying, okay, we'll allow this, but we're going to charge you a little tax for this service until you get to what the industry has determined to be the acceptable measure of 80% loan to value. That means the equivalent of a 20% down payment. Once you reach that section of leverage, you can get PMI removed. Then you can remove that little extra payment on your monthly mortgage.
There you go. Now, it comes in different names for different types of loans, like it's called PMI on conventional loans. It's called MIP on FHA loans. What is it called on a VA loan usually?
There is none. That's the benefit of VA loans. There is no mortgage insurance. It's called zilch.
It does not exist. So when you're looking to buy a house that you are going to live in, you get the best loan options because you can put way less money down and you can get into the real estate game much easier. Also, your rates tend to be lower than if you're buying a property you're not going to live in. Christian, in general, what's the difference in the loan range between an investment property and a property you're going to live in?
So in terms of rates, typically between a primary and a rental property, we're talking maybe on the low end, a 0.75 to 1% rate difference, all the way up to maybe a 1.5 rate difference. So it's a fairly decent swing, especially when you consider investment properties also require a larger down payment. So you got to bring more money to the table and have a higher payment in a lot of cases, which is why, guys, if you're not using your primary residence token every year with these 3 and 5% down loans, and now you can buy multifamilies, like this is how people grow wealth, right? They're low down payments, low barrier to entries, better interest rates. You might as well use it.
All right. Now, speaking of investment property loans, these are going to be any loan where you're not living in the property, and they come in two main flavors. You have a vacation or secondary home, which you may have heard of before, and then you have an investment property loan. The biggest difference would be what, Christian?
Vacation or second homes, that we call them in the industry, does require 10% down payment, not all the way to investment, being the 20 or 25% down, but not as good as the primary. So 10% down, pretty good entry point. The rule with vacation homes is that you have to occupy them for at least 2 weeks out of the year, and they have to be available for you to occupy for half the year. 180 days where you could make a 24-hour decision to go walk in and actually walk in for 14 days. Okay. You can rent it out for the rest of the period that you're not there on Airbnb, VRBO, whatever the case is. So that could be like a pseudo investment property. And then the true investment property loans require a minimum 20% down. Then that's where you're renting it from day one to a long-term tenant or short-term rental right off the bat. Those are the higher interest rates, like I just shared with David, 1 to 1.5% swing from where conventional rates are. And I want to comment on something David said earlier. This is the exact same scenario we've heard so many times. A borrower that says, oh, my buddy got a 6.5% loan and I'm getting quoted at 8%. Well, your buddy bought an FHA 0% down. You're buying a 3-unit rental property. Like, they're entirely different loan products. It's comparing apples to oranges. You can't put those two things next to each other and say, compare my rate, right? It's an entirely different situation.
Yeah. Rates depend on things like how much of a down payment you're going to be using, if you're living in it or not living in it. These are all things that lenders evaluate for risk. Your credit score is one of those things, but it's not the only thing, and it's not even the biggest thing. And then other things like your specific debt to income ratio, what other investment properties you might have. There's a lot of little nuanced things that your loan officer will look at and you could be dinged for, or you could get bonuses for. But the point we're making here is it's not like it's a 5% difference. All of these things typically fall within a 1% or even less than 1% rate difference here. So if you're worried about that, just talk to a loan officer, start the pre-approval process, and let them ask you the questions. And then a good one will explain to you, hey, if we can bump your credit score from here to here, or if you can pay down this line of credit from here to here, we can usually get you 1/8 of a point better or 1/4 of a point better, depending on what the thing is, to improve your rate to the best possible amount. What are the main things that people need to know if they want to get approved for a loan to buy an investment property?
Yeah, biggest thing is, first and foremost, pick which bucket you want to be in. And what I mean by that is the type of loan underwriting, right? And we've done previous episodes about this, but bucket 1 is what we call full doc underwriting. So that means you qualify with the things that you hear on BiggerPockets: debt to income, loan to value, your assets, your reserves, right? You qualify with full documentation. That gets you the best interest rates because it's the most strictly underwritten, right? If you don't qualify for that, there's a 10 loan limit for those. Or there's, if you don't qualify debt to income because you're a business owner and you write off your money, whatever the case is, you can get into the second bucket, which is, we refer to it as a DSCR loan, a debt service coverage ratio loan. Okay, that's where the property now qualifies instead of you. That's still a 20% down requirement. You just need to buy a cash flowing property now. Third bucket is hard money. That's highest rates, lowest underwriting. If you got 25, 30% down, you can buy anything you want. So first step is get with the loan officer, get the advice and guidance. I'd recommend, guys, work with a loan officer that offers all 3 of those buckets. Because if you go to just a DSCR lender, but you qualify conventionally, they're not doing the best service they can for you because they can't offer you the best product that you qualify for. Right? So talk with a couple lenders that offer all of these products. They can guide you, specifically to your situation on which of these buckets you should be fitting into.
Okay, now, if you're listening to this, you're likely a real estate investor that wants to build wealth from real estate. God bless you. We love that. But you also may not have 20% down to put down on a ton of different houses. If you're buying a $500,000 house, 20% down is $100,000 plus closing costs. How many of these things you're going to buy before you run out of money? So one of the ways that we recommend for people to scale a portfolio is to use primary residence loans where they can put 3 to 5% down and then buy properties that they can move out of after a year or longer, depending on how long they want to wait, that would then function as a rental property with cash flow so that they can buy their next one. I call this the sneaky rental tactic, because instead of putting 20% down on an investment property, you put 5% down on a primary residence and then move out of it and make it an investment property, which keeps you with 4 times as much capital to be able to go buy the next deal, improve the property, add square footage to it, whatever you're going to be doing. We call this house hacking. It's when you buy a house and rent out parts of it. You can rent out rooms, you can rent out space in the house, or you could buy a small multifamily property, live in one of the units and rent out the other ones. When it comes to applying for a loan, Christian, is there anything that people need to know about a primary residence loan when they intend on house hacking specifically?
I'll list 3 things here for people, mainly buying their first investment property, especially going into 2024 when we're projecting and kind of forecasting a lot of these rate decreases. I think this is going to be an entry point for a lot of people. So it's very important you get your ducks in order now. 3 main things for first-time home buyers. Number 1, target the asset type. So multifamily, like David said, is great because when you go in to qualify for multifamily, let's say you get pre-approved for $500,000 for a single family home. So that's just with your income, your debt to income, your work, your W-2, whatever it is. If you go buy a duplex, triplex, or quadplex, you may qualify for $600,000, $700,000, $800,000, even though your income only support $500,000. And that's because when you buy a multifamily, we can use the rents from the other units to add to your income. So buying a multifamily actually increases what you qualify for. So that's where you can get into a higher value property, still keep that low down payment, and qualify for more than what your W-2 actually will let you get. Very, very strong tactic. And a lot of these people who build up a portfolio of 5 or 6 multifamily homes, this is how they did it without expensing massive amounts of down payments. Okay. That's number 1. Number 2, we can add up to 4 people to a loan application. Now, this is not me advising go out and buy houses with a bunch of random people. But if you got a sibling, a spouse, a brother, a niece, somebody who you're planning on living together anyways, I know a lot of people go into house hacking already with a couple tenants selected. Oh, I can rent out to my brother and I can rent this out to my friend. Is there a benefit there for you guys to pool your funds, go in on a property together and still rent out a couple units, occupying the house that you were going to be occupying as a, co-living situation anyways? We can do that, pull some resources, pull some down payments, pull some income to help you qualify. That may get you over that hump for a lot of first-time home buyers. And thirdly, gifts from family. This is how so many people are buying houses from their parents, grandparents who have owned real estate, who have cashed out, who are now helping their kids and grandkids buy real estate. You can use gifts on primary residence loans. Right. So it doesn't have to be your money if it comes from a direct family member. Let your parents help you if they have obviously not everybody's in that situation, but if they are, don't just let that money sit in a CD or a high yield savings account. Get it into a real asset, get it into something that's going to limit your monthly expenses and potentially get you some rental income in the future as well.
Now, a lot of people get hung up on the fact that when they buy a house to live in, it doesn't cash flow, and they've been told that they have to cash flow. But what they may not be realizing is that they're already negatively cash flowing because they're paying rent. If your rent is $2,500 a month, you're losing $2,500 a month right off the beginning before you've analyzed anything. And so anything less than $2,500 a month in your housing expense is a win for you. Furthermore, your rent usually goes up every year. It's $2,500 now, it's $2,650 next year, then it's $2,850, then it's $3,000. Rents keep bumping up over time. So when you buy a house, it may look like it's more expensive to own than to rent. But if you look 5 years of rent increases, it actually was cheaper to buy a house, and it becomes significantly cheaper after 15 years. House hacking is brilliant because not only do rents not go up on you and you save money, but the rents you charge your tenants go up and you make money there. It actually helps you on both sides of inflation, which is why you build wealth through delayed gratification and real estate. So Christian, if people are interested in house hacking, if they want to take control of their finances, if they want to stop just flushing money down the toilet, giving it to their landlord, and become the landlord where all the money comes to you through that same toilet, how can they reach out to you?
Yeah, obviously all the above, guys. It's not a secret by now. We offer this. We'd love to help you out. My handle on social media is @TheOneBroker. Instagram's usually the best to reach out to me. Obviously, our website as well as theonebrokerage.com. Little apply now button in the top right. Click that. Get in touch with the team.
All right. And you can find more about me at davidgreen24.com or at davidgreen24. And BiggerPockets has more than just a YouTube channel. We've got an entire forum full of tons of questions about loans and everything else that you could ever imagine. Check out biggerpockets.com/forums to visit those and learn more, or read our blog, or go to biggerpockets.com/store and see all the books that we have to offer on topics like this, as well as others. Thank you so much for joining us. We really hope that 2024 is the best year that you could possibly have, and that you do get that first property and start building momentum on creating a portfolio to build wealth for yourself today. This has been David Green and Christian Batchelder for BiggerPockets Mortgage Mondays. If you've got a minute, check out another episode, and if not, we will see you next Monday.